Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do a stock analysis for Flutter Entertainment. About a year ago, I made a video here, and it was at $265 then, and I was saying it's overvalued. I don't understand why Wall Street is buying this, and the stock has come down a ton since then. But the main reason I'm making this video is because I got a comment a week ago on this saying, great prediction on the stock's future. Could you do an update as I now like the stock? So this is for Patrick McGabe. And I just want to do an update because the stock has come down a lot. The valuation is in a totally different place. As you can see, it's been from $300 a share last summer to now only $100 a share. So valuation wise, it looks really nice right now, especially on a price to sales basis because the sales for the company has not stopped. The growth has maybe slowed a little bit, but you got to think there's a lot of competition in this space. And they talked about, I read something with DraftKings is taking a lot of market share. There's a lot of competition. Not only that, but especially at this stage in the game, you have all these different companies offering free bets and all these, promo things. And so, of course, that's going to hurt your bottom line. But they are growing sales. So technically, they should still be a very strong player market share wise because FanDuel is one of the most, that's one of the more popular ones. But does it mean I want to invest in this right now? Not necessarily. Shares outstanding is pretty much flat, so that's not a problem. If you look at this valuation chart, you can see over the last 3 years, this is by far the best deal you're getting from the perspective of free cash flow. The free cash flow is the highest it's been relative to the price you're paying. So that's that's a good thing. Price earnings can't look at because they're not really making money. Price to sales, another great one. Back just 3 years ago, you were paying 5 times sales. Now you're paying a one. So again, if you're interested in this stock or you still believe in FanDuel and stuff, I think this is one of the more attractive places. This is the most attractive place probably you could have bought the stock in the last couple of years. Cash to debt is not great. Of course, they are losing money. Negative EPS, negative net income. Free cash flow has been positive, which is good, but I mean, it's shrinking. So that's not the best thing either. Then we go over here. We can see what Yahoo Finance has for analyst estimates, growing 14% this year, 11% next year. Again, it looks like growth is slowing. The thing though is you could also look at this like there are certain states that are still, could still legalize sports gambling, and then that could open up a new market and growth could go back up. So yeah, it's kind of hard to predict. You don't really know. And then here, I always like looking at EPS from a gap perspective just because their adjusted numbers can sometimes be way out of line. As you can see here, $7 when gap is technically closer to 3. But so they had negative EPS last year. This year, 3.4 expected. Then next year, 7.4, which is an insane jump. Which, that then I could see the stock being a lot higher if they're reporting over $7 of gap EPS, then I could see the stock being a lot higher. But again, I would say it's an interesting play. I'm not going to say it's bad. It's just I don't know if I would invest in this right now. But the valuation is cheap relative to where it's been. You're paying 14 times next year's earnings. That's cheap. Price to sales of 1, cheap. Free cash flow yield of 3.6, not bad. But just consider if this keeps going down, if this is 500 million this year, well then that free cash flow yield is going to go down, and probably the share price will go down. So just take that into consideration. But if they do positive EPS in 2026, this could all flip, and then let's say they do, let's say it goes back up to $2 a EPS. Well, they're expected to do what? Over 3, right? So if they do $3 a EPS, I mean, there's different ways to look at that, but I would say it's probably going to be close to the share price we're at right now. Um, the stock is down a lot. The sales are up. It's just a matter of, do you think that they're going to be the dominant player for years to come in the future? And then once that happens, once it's less competitive and the market consolidates into fewer players, then these companies should be able to report a profit, right? Because we want net income and free cash flow to be positive and trending up, but that's not happening right now. So just things to take into consideration. For me, it doesn't stand out as a huge buy right now, but like I said, if you are bullish on this company um, or you think that FanDuel is, going to be the winner, which, again, they are growing sales, so they very well could be, and they already have one of the largest market shares. So they're definitely a significant player in the space. It's just a matter of they need to keep going and they need to be able to flip it to where they become profitable. That's it, which I don't think is out of the question. So if you're willing to take that chance, this is not a bad valuation to do it at. Again, 1x price to sales, which is nice because they're actually growing revenue, right? They're growing at 16, 17% per year on average. And then PE of 14, which is also very cheap. So that's kind of my take on this. We can even come down here and also see like if insiders are buying. No, insiders are not buying. But here we can go to Robinhood too. Oh, okay. You can't even see what hedge funds. Anyways, you get the point here. The point is the stock has come down a ton, which is very nice. They're growing sales. There's a good chance that they are the dominant player. And as long as they could flip net income and free cash flow in the next couple of years and keep it trending up, then I think this stock has a good future ahead of it. And hopefully it can get to back to $200 a share in the future. But as of right now, you are paying $18 billion for a company that is losing money, has a little bit of free cash flow, but is downtrending, and then they have very solid sales. So I think it's really just a matter of when does the market consolidate, when does it become less competitive, and have fewer players, and they could stop issuing all those free bets and all that stuff and all the marketing spend. So that's kind of the way I see this. Let me know what you think down below, and I will see you in the next video.